Welcome to our video analysis on the topic why the US economy is suddenly looking a bit shaky. We will delve into the recent economic instabilities in the US, uncovering the diverse elements that have contributed to this ongoing shift. Our investigation scans the areas of inflation, interest rate hikes, and market volatility as crucial players in the game of economic balance. The price tags that are attached to goods or services encompass the concept of inflation. As inflation goes up, the purchasing power of the dollar decreases, and this can push consumers towards a state of economic discomfort. One of the major reasons behind the current shaky look of the US economy can be traced back to inflation, which has stubbornly lingered above the Federal Reserve's target rate for several months. This prolonged high inflation functions as an additional pressure on the monetary policy. In a bid to address the pricing surge and preserve the economic value parity, the Federal Reserve increasingly attenuated its monetary stance through several incremental rate hikes. Though these steps set out to control the inflation could, to an extent, unsettle the financial markets due to the prevailing economic sensitivity. Market volatility shoulders its part of the responsibility as well. Characterized by broad fluctuations in prices and supreme uncertainty, it intimidates investors and undermines consumer and business confidence. This gives major risk signals to the equities, bond, commodities, and currency markets, which consequently may impair the overall economic activity and drive the overall economic landscape into a state of uncertainty. Rising inflation and determined interest rate hikes induce a reciprocal spiral of events. These adjustments imply higher borrowing costs for common businesses and households. In turn, borrowing becomes more expensive, profitability gets squeezed, and ultimately, consumers and businesses take a hit. This can dampen consumer consumption, which in its way can propagate through into decreased economic growth and lower labor market performance. Despite these observable effects, above-target inflation and interest rate climbing unanimously signify to the market players that the economic policy authorities are fiercely geared towards avoiding an irredeemable economic scenario. Still, the immediate reaction to these determinations could inject additional ambiguity into the markets, potentially culminating in pronounced market fluctuations and beleaguered investor sentiment in the near term. This, compounded with the escalation in geopolitical risk events, has taken a mental toll on the market participants. Geopolitical risks have the potential to wreak havoc on international trade and geopolitics. Unrest in regions like Ukraine, Afghanistan, and tensions between Russia and the United States, as well as other geopolitical issues, have a deep influence on the global economy, making the US economy sensitive to their impact. Accommodative monetary policy, held in place to insulate the economy against the tropes of the pandemic, has undoubtedly overstayed its welcome. As the measures dedicated to restore pre-pandemic economic conditions are unwound, the market has chimed a note of preemptive volatility that epitomizes the expectations of a twisting economic cycle. The economic hikes greatly underscore a crucial point that the carefully synchronized efforts by policy actors, be that in monetary or fiscal policy, should produce a streamlined and ordered impact. However, the marketplace expectations unfolding in the heat of these pressing economic measures reveal fissures in the comprehension of the pacing and sequencing of these policy moves, casting a long shadow of uncertainty. The sequence of these policy actions, ruled by their spillover implications, very frequently impact the risk profile of market assets and investment avenues. The punishing rotations within and across investment sectors witnessed currently are not relics of past market dynamics. Instead, they underscore the evolving terrain that market participants are navigating today. At the crux of these fluctuations lies the Consumer Price Index, CPI, which has consistently exceeded the forecast range throughout the past improvements in the US economy. These peak levels of inflation have scrambled up policy dilemmas around interest rate management and pointed perilous balance concerns, since the risk of ingraining expectations of sustained inflation is real. The impulse behind reinventing the economic growth narrative has triggered the formulation of nerve-wracking market reactions. The spillover impacts of reforming strategies, coupled with stringent policy alterations, have set off alarm bells across market segments. They reverberate with uncertainties, citing the disrupted guidance that investors and market participants have relied on in the past. The apprehensions of policy overshoots, underscored by escalated inflation, narrate a tale of discord with the orderly progress of economic recovery. While this has clutched at the sentiment cycles in the market, it has also prompted a corrective phase, evidenced by the risk-off moods that ricochet through the regular market trading alcoves now and then. This disruptive economic phase mirrors the turbulence of choices that policy actors face. With a desired end in sight but paths uncertain and fraught with risks, the polarity of opinion is wide-ranging and the potential outcomes diverge significantly. This causes contradictory market movements and places investors in a tenuous position as they try to make sense of the unfolding economic landscape. Switching scenarios where inflation overshadows economic growth makes for a puzzling landscape. It implies that policy prescriptions, which were unambiguously constructed to support economic expansion, now to a larger degree, are plugging adverse inflationary pressures. This policy evolution is an acknowledgement of the changing framework within which economic choices are being made. As the endpoint of inflationary pressures remains uncertain, it feeds into the fabric of the current market instability. This instability seeps into the anxieties of investors, influencing their market transactions and sets off deterministic narratives of economic turbulence. Consequently, this poses significant risks to the overall health of the economy and the robustness of the financial systems that underpin it. The delicate balance of pulling back the accommodative measures slowly and the urgency imposed by rising inflation adds a layer of complexity to ongoing discussions. This transition phase, where economic convulsions and apparent strains on economic growth are prevalent, testifies the taxing journey the U.S. economy is currently on. It's clear that the magnitude and persistence of inflation surprises in the economy suggest that market participants continue to recalibrate their expectations. This recalibration could be tumultuous and protracted, setting off long drawn-out market unrest that could strand the global financial system in an uneasy state for some time. As the cyclical forces of realignment continue to throw economic growth estimates off balance, fostering stability in the new dispensation necessitates a calibrated acquisition of market information integration. And, guiding the economy through this critical juncture calls for a meticulous deployment of available policy instruments, backed by bold and concordant action. This trilogy of persistent inflation, escalating interest rates, and rampant market volatility have together placed certainty and stability into short supply. A juncture where market sentiments oscillate between hope and fear, certitude and ambiguity, will certainly test the resilience of the economic recovery path. The transformation of monetary policy from a support stance to a tightening phase is gradually taking shape. However, the pace and rhythm of this change continue to set challenges to market players. This simmering discomfort in the market brings forth competing signals and fosters an environment in which flashpoints are swift and indecision settles in. Bridging the gap between economic reality and market expectations mandates recurrent dialogue and stimulus-responsive inputs. This resonates to synchronize policy expectations in a manner that affirms the central role of policy in shaping the economic landscape and underscores the unity of policy action in fostering sustainable growth and stability. Amidst the discourse on policy evolution and market realization, the impending resurgence of business cycles also fills the air. The looming prospect of peak inflation and the potential deceleration of growth forces a reassessment of market valuations and risk tolerance levels, setting the stage for impending volatility and uncertain market dynamics. As the U.S. economy shifts gears towards climbing rates, the ephemeral environment combined with inclement market conditions is likely to impose a period of outlook adjustments. The economics of transformation, driven by unprecedented conditions and new benchmarks, pose significant pressures on the market areas, where fragilities are ripe. As the transition from the low-yield environment to high-yield terrain unfolds, enterprises on both Main Street and Wall Street are preparing for a sterner test of their capital structure. The reverberations from this shift are being felt across the financial landscape as asset valuations come under the scanner and market indices jostle in search of equilibrium. The likelihood of wage inflation and its implications for the labor markets is another twist in the tale. With mounting pressure on wages, businesses could face higher labor costs, which, if not matched with corresponding productivity gains, could eat into their margins, leading to a spillover effect on employment trends and economic growth. The resolve to juggle multiple parameters of economic management in the face of heightened uncertainty and divergent interpretations underlines the complexity of this ongoing structural realignment. It underscores the trials that policymaking faces in the pursuit of an equilibrium that balances the need for growth, the specter of inflation, and the imperatives of maintaining market stability. The final segment of our analysis rests on the outlook for the U.S. economy submits to the emergence of a distinctly different economic environment. The norms of the past tethering economic policy action could potentially shift, leading to a recalibration of expectations from the markets and a realignment of market positioning. The climb towards a different endgame reiterates the tolerance for temporary economic discomfort that cannot be avoided. The forthcoming twists and turns that the shift in monetary policy and the evolving market dynamics will bring could be psychologically unsettling for investors who have grown accustomed to prolonged stability. It is important to appreciate the distinction between the immediate and intermediate impact on the economy and the resurfacing environment, which could translate into differing scenarios for stable asset markets. The economy's inevitable path to a steadier and balanced norm does not imply a smooth and calm transition on the way. Time will tell how smoothly this transition will unfurl and what the long-term implications of these changes will be. At the heart of it all are the millions of individuals whose lives are impacted by the economic vitality of the U.S., emphasizing the human dimension embedded within the fluctuating narratives of economic stability and veiled uncertainties. As the tapestry of economic narratives continues to unfurl, and the debate between policy and markets intensifies, investor response will be critical. Policy buildups and sentiments take the gestalt shape reflecting the economy and will continue to inform market responses. So, what happens next and where the U.S. economy stands in this maelstrom is of vital significance. The U.S. economy does not exist in a vacuum, and the repercussions of these economic dynamics will be felt both within and beyond its borders. As we look ahead, with ongoing global challenges and the overarching impact of COVID-19, the ripple effects of U.S. economic shifts will likely be a defining factor. As we chart our course in these turbulent times, it is apparent that no one has all the answers. This uncertainty is both a challenge and an opportunity, reminding us of the complex nature of economies and markets and the need for a multifaceted approach that incorporates all relevant data and analysis perspectives. The U.S. economy's sudden shakiness has triggered anxieties and uncertainties amid policymakers, market participants, and the public at large. But the story of the U.S. economy is not solely a tale of uncertainty. It is also a narrative of resilience and adaptability, a beacon of hope in unstable times.